If anybody ever tells you the business is easy, should have their head examined. My next guest is Joe Davy. All right, so he's involved in a startup called Banzai. He received venture capital funding. Now, it is difficult to go from 0 to 1 in any business. But then we had COVID, Black Swan event. That almost killed his business. What'd he do? He goes back to the VC fund managers and said, hey, we got to pivot. We got to pivot fast. So he acquired companies. And then they said, we need to raise more money. So they went public through a SPAC. And now the SPAC, which was worth at $10, is at 30 cents. So anybody tells you it's easy, it's not. But this is a story about resilience and overcoming obstacles. So let's watch a video. Welcome to the show, Joe Davy. How are you?
Thanks, John. I'm great. How are you today?
Well, you started Banzai 2016, and that's kind of a webinar company creating an ecosystem marketing technology solution. So tell me a little bit more about it. Now, you're a tech guy in the background, Silicon Valley or Seattle kind of tech person. So you've been doing this for a while, right?
Yeah. We're the other white meat of Silicon Valley, I mean, I'll just give you a little bit of my background, maybe a little bit of Banzai. So my background is, as you said, as a software engineer. Worked briefly at IBM, did some consulting, started one of the early big data tech companies, EvoApp. Worked a private equity firm for a little while, helping them with some internet tech investments that they made, and then ultimately joined Avalara in 2013, and then was there for a number of years. Grew it through 250 million in revenue, something like that. Now part of then founded Banzai, as you said. We launched in mid 2017, and we've been kind of on a tear. I'll tell you when we first started Banzai, I would say like our theme throughout Banzai has been basically building a data-driven platform for marketers, initially with the goal of helping them grow their pipeline, hence Banzai pipeline, right? So that's where the name comes from. But we started our first product, it was actually a precursor to our current Reach product, which we just announced. Reach 2.0 came out today. So we're super excited about that. But Reach basically, what it did, we had this insight that marketers had trouble getting people to their events, getting butts and seats for their events. And the biggest challenge wasn't like, how do I contact them? How do I send invitations to them? The biggest challenge was, who do I invite? Got to find the right people. And so the problem there is there's no data set at the time. There was no data set before Reach that would tell you, with a high degree of accuracy, what somebody did, where they worked, what their seniority was, their firmographics, demographics, but also their geographic information. So where that person actually lives. And with COVID, this has become an even bigger problem because now people often don't live the same place their company's located. So just knowing that somebody works for Google doesn't tell you they live in Mountain View. Somebody works for Google could live in Nebraska. And so we built basically a data-driven product that would somebody be able to put in their profile of exactly who they were looking for, but then also where their events were going to take place. I'm doing 10 events across the country or internationally or whatever, and I want this profile there. So Reach was really good at driving highly targeted butts and seats for those events because it was able to send the right invitations that were relevant to people based on where they were, what they did, what they were interested in. That business did really, really well up until about March 16th, 2020, when the field marketing business completely
Everybody's
evaporated.
Everybody's got a COVID. It changed the business story. Yeah.
That's right. Yep, that's right. So at that point, we had just raised a venture capital round. And I think our first board meeting was like the first week of March 2020.
Oh my God.
And at that point, even it wasn't clear that this was going to be a problem yet. And maybe it was the last week of February. And so people were still kind of, nothing had been shut down yet. Everybody was still just kind of thinking this was going to blow over. And we had a board meeting and, we said, this could be a problem. We're not sure. We're monitoring it. And I think at that point, maybe Facebook had canceled their big conference. Adobe had canceled their conference, which were both customers of ours. And so we just said, like, well, this could be something. We don't know. This might blow over. Probably it'll be done in 6 months, and at the most. But we'll see. Anyways, obviously we all know how it went. But we made a business decision that year that once we saw what was happening, we decided we're going to take some of the capital that we had and we were going to invest it in shifting to digital. And so we acquired business called High Attendance, which was a virtual event software event management platform, software as a service company. And then we also in early 2021, we acquired Demio, which was a webinar platform, and Demio just got named by Forbes as the #1 webinar platform for marketers. So,
and this is for bigger companies too, right?
It's for companies of all sizes. We have in the neighborhood of 3,000 customers, and they range in size from small businesses all the way to Fortune 500. So companies we recently announced with Reach 2.0 today, we announced Cisco, CrowdStrike, Ring Central are customers of ours. But we also have a lot of people that maybe startups or even solopreneurs that use Demio to just help them talk to their customers or talk to their prospects. It's a really powerful product. It's super flexible, and we offer a couple different packages. So we've taken a PLG strategy where customers can start on the low end, and then as their needs expand, they can expand up and kind of buy more capabilities. So you don't have to spend a fortune to get started with it. It's affordable to get started, and then over time you can expand. And we've had customers on that product that have gone from spending $100 a month to spending $50,000 a year.
Wow.
So it's a really cool product for customers because it enables them to do so much. And again, like the whole theory behind it has always been, like, our DNA has always been data-driven products. So Demio, the whole thesis, what makes it special for marketers is that it's so focused on the data, the capabilities it gives marketers in terms of the reporting that they can see, the activity that they can see, the tracking, the integrations, all that stuff. Are super important.
Tell me a little bit about where you were at financially and emotionally when this black swan of COVID hit. Were you cash rich from cash flow from the business, or was this still VC money? Because I have a little experience with that because started TurboSquid a long time ago. We raised about $5 million for that, and the runway took a lot longer than we ever expected on it. I mean, it was years later sold to Shutterstock, but nobody got rich on off a 20-year exit.
Yeah, well, right. I mean, time kind of, if you got a great business, time is your friend. If you got a struggling business, time is your enemy. So we went from, in March 2020, we went from time being our friend to being in a race against time, basically, because, our sales went down in that month from the beginning of March to the end. Our sales decreased by over 90%.
Jesus. Yeah.
So we were looking at this like, wow, this is an existential crisis for us, kind of.
It was.
Yeah. And so that's why we said, we have to find other ways to support our customers. So that was what the shift to digital was all about.
And was this VC money that they did we had to be very transparent with exactly what was happening, because we always had the phone call, speed dial. There's a red button to our VCs. Hey, this is what's happening, good or bad. We wanted to know what's going on. Did they support this? Okay, let's shift. Let's go buy digital stuff. It's going all online.
I think they basically looked at this as like, wow, this is going to be the fastest we've ever had an investment go to zero, because we cashed the check in February, and then like by middle of March we're like, well, we're screwed. The whole market is gone, and we don't know when it's going to come back. So we had some money, we had some runway, and so fortunately they were super supportive. They understood the situation. We had a lot of conference calls with other founders. It was Mitch Kitamura, who's a super experienced, really, really great investor, and from Draper Nexus, and so we DNX, which is now DNX Ventures, and so we had a lot of conference calls going on with their other founders and stuff like that, and people were saying, okay, people who were in businesses that were gonna probably be totally unaffected, like robotics businesses, were already laying off half their staff, or three-quarters of their staff, and going to the mattresses, and we just said, like, okay, well, our version of going to the mattresses is a little different. We're gonna try to change our strategy. So we kind of did more of a move to Vegas approach versus a shut the
Yeah.
business down approach, to borrow a Godfather reference.
When
So,
you,
anyways,
yeah, the mattress, mattresses thing. Let me ask you about when you reached out to high
yeah.
attendance and Demio. What kind of conversation starter or opener up was this? I mean, like, oh man, we don't know what's happening here. Come, come under us. You'll probably survive. What was it?
Well, those businesses were doing well, right? Because they were obviously in demand. So, like, Demio had seen their business go from under $1 million to like 2.5 or $3 million at the time, and so they were obviously on the upswing, and because they were in a very high demand segment all of a
Yeah,
sudden,
yeah.
right?
Like Zoom went
There
from
was a
yeah,
huge spike, right? And as you would expect, and yeah, I mean, the conversations were we just really the timing worked out where the founders felt like that in the case of Demio, they'd been at it for like maybe 7, 8 years. They had loaned the business a lot of money. Both the founders, two guys, really sharp, really smart guys, really good guys. But yeah, both of them, but had most of their net worth tied up in the business, and so I think they just looked at it as like, hey, can we, maybe this is an opportunity for us to get out. And without going into too many other details, but we got connected through a friend, who knew that they were potentially open to selling, and so that's how we kind of started talking with them. And once we got to understand the business a little bit more, we just said, yeah, let's move forward with
yeah.
it. So
How did you
we
value them? Without being specific, if you're under non-disclosure, and how did you
yeah.
buy them? Like, was it 100% cash? Was it 50-50 earn out seller financing? What did that look like?
Yeah, so we borrowed some money, and it was there was an earnout component, there was a cash component, and there was a stock component. So they got some shares in Banzai, they got some cash on close, and then they had an earnout as well. I don't know whether I can say what the exact numbers
No,
were.
no,
Everything
don't
it,
worry
it
about
might have
it.
been
No.
publicly disclosed or whatever, but yeah, it was a structured deal, and that enabled us to get the upfront purchase price to a number that they felt they were going to be comfortable with, and that we felt that we could deliver
Yeah.
on. So
Did
yeah.
you, with this valuation, do you think it was too high, too low now after buying it? Or,
Well, in retrospect, it's been a great deal for us, and I think it was a good deal for them too. So I think it was like a Goldilocks type of deal, because they managed to kind of cash out at a really good time. The business obviously continued to grow from the time that the deal was struck. So in adjusted purchase price terms, our multiple has been, if we look at the revenue today versus what we paid for the deal, we paid a really fair multiple for the business. And then we've also been able to help the business. I mean, one thing we think about is where can we strategically add value. And so in this case, we just saw they were really focused on SMB at the time, which we knew was going to be a higher churn customer, and we knew it was going to be just a smaller average ticket size. And so we said, hey, we have, one asset that we had, an intangible asset, was we had a lot of these reach customer relationships. We had maybe 250, 300 customer relationships, and a lot of them were bigger companies, mid-market to enterprise companies. And so we said, hey, we can take this product to that market. And then we said maybe we can retrofit Reach to work for webinars too, to drive attendance for
oh,
webinars. And
yeah, there you
so,
go.
um,
Cross pollination.
yeah, so
How did the
yeah, so that was
conversation go with the VC? Because they have an equity position, and you're gonna dilute that a little bit, and they're always prickly about that.
Yeah, I mean, the nice thing is like, this was like a little bit like, it was a little bit like, somebody tells you you have stage 4 cancer, and then they turn around and they're like, oh, never mind, that was just a funny looking mole. If you get a solution for it, people are very open to solutions when they think the alternative is death. So that's what we were looking for at that time. Was we were looking for a good solution that we thought would enable us to keep the business alive, shift our focus, and ultimately, just reorient our team on something that was going to be more productive. We didn't know how long COVID was going to be, so we looked at it and said, it's a possibility that this is over in 6 months, and in that case, making making an acquisition might be stupid. But by the time we got to February 21, we were a year into the thing almost, and we knew it wasn't going away anytime soon at that
Yeah.
point, and we didn't know how long it was going to be. And we're glad we did, because honestly, the reach business, I mean, we just saw demand continue to stay very, very subdued for that business up until really the first quarter of 2024. So we've only just recently started to see inbound pick up and start to see customers come back, and people start to make field marketing investments again. Marketing machines, especially in mid-sized or large companies, the wheels can kind of turn slow, and marketers think about budgets in terms of annual budgets a lot of times. So they think about, you got to have a budget, then you got to staff, then you got to plan, then you got to
And lots
execute,
of
and
conversations. Yeah.
a lot of conversations. So, if people started to bring back, maybe 2020, everybody started to kill field marketing, then 2021, they killed it for sure because they knew it wasn't coming. Maybe they put it in stasis in 2020. They killed it in 2021. They left it dead in 2022. They started to talk about bringing it back in 2023, and we're just getting to the point where it's actually starting to come back in 2024. So that's great for us. That's why we've invested more in this reach, in our reach product, which we're super excited about also.
And
And we launched it today. Our motto is that we help companies get butts in seats. So we took a giant picture of a corgi butt and we put it on the NASDAQ tower, and
that's
uh,
good. Have fun
and
with it.
yeah,
Yeah.
yeah,
Tell me about
exactly.
the high attendance, the acquisition. How did that transpire? NDA
Yeah,
approved, specifics on that.
yeah, that one was just a lot faster of a deal. We basically did a part cash, part stock deal there, which I believe the consideration was all up front. And there it was really, we had a great guy, Chris Justice, who stayed here for several years and helped us navigate that business. And we knew that we needed to get him to come across with the business. So there was an earnout component to it that was tied to
Yeah. Did
vesting
that
a
earnout
portion of the.
pay out for him? Sometimes earnouts don't work. The reason I'm asking. Yeah.
Yeah, I think a portion of it. I think he ended up retaining a portion of it, and didn't retain a portion of it. Ultimately, what we decided in 2022 or maybe early 2023 was, we looked at where the business was, and we just said, the dynamics of virtual events were totally different than the dynamics of webinar. And we didn't have as much of a way to make virtual events a data-driven thesis. For webinar, it was really clear. For virtual events, it wasn't. I mean, they had built a really cool product, but also it was really a complicated product, a lot of setup costs, stuff like that. And we started to see the market shift when people started bringing conferences back in 2023. So a lot of the conferences came back before field marketing, and so when that started to happen, we started to see these tools like you basically had this huge boom in virtual events. You had like Hopin and companies like that went from, Hopin was like an $8 billion company at the peak that then got sold for 15 million or something
Yeah. Yeah.
at the bottom. And so we just looked at it and said, we just don't know what's going to happen in virtual events. It wasn't really a market before COVID, and we just couldn't maintain the thesis that it was going to be a market after COVID. As people started to bring events back, and we couldn't really make the thesis that we were going to be the competitor to beat out Cvent and Aventry and some of these other larger, Rain Focus, some of these other larger players that were doing really well, that it was a lot easier for them to pivot their in-person conference tool into virtual than it was for a virtual platform to pivot and do big conferences. And so we end up cutting a deal with Chris where we end up selling the assets of the business back to him
Oh, is that right? Oh,
in
interesting.
either
Yeah.
late 22 or early 23. Yeah. And it again, ended up being a good deal for both of us. And he then took the assets and, refocused on the business and ended up selling it again. So, it, ended up being a double dip for him, which was great. And, it was good for us because it allowed us to just focus in strategically on the Reach and Demio businesses. And we launched another product called Boost around that same time. And so it was a good decision for
Tell me
everyone.
about how you went
Um,
public. Is it you went through a SPAC?
yeah,
Yeah.
yeah, we
And
did.
was this
Yeah,
this is like the peak of the SPACs, or and
yeah. At the time, it was like, hey, this is a really good idea.
yeah.
You know, and then obviously, like the SPAC market also again changed. So, sometimes you're on the lucky side of timing, sometimes you're not. But I think just as part of but I think I talk all day about I think what's happened in the SPAC market, but essentially the challenge has been when the overall market went down in 2022, the people who were really smart were the investors who put money into SPACs and were holding
Yeah,
on to the
yeah. There,
stock at
I
the
read
top.
something on I either Reddit or Twitter at that point was following Chamath Palihapitiya about the SPACs,
Mm.
and he was the king of SPACs. And they're like, look, the only people making money are Chamaths. That's it.
Yeah, there's some truth to that. Although what I'll say is the people who made money were the people who invested in the SPACs, and the reason for that is you think about it. You buy a SPAC. What are you really buying? Is you're essentially buying an exchange traded T
Yeah,
bill,
it's a shell
right? Because
company. That's it, right? Yeah,
the SPAC takes all their money, they put into a money market fund that's going to basically pay a rate similar to Treasuries, and so during that time, treasuries went up. The stock market in general went down, but SPACs were all pegged. They have this redemption rule that basically allows you to get your money back out if you don't like the deal at the end.
right.
So there were a lot of people that were just super happy to sit on these things for as long as they needed to, because if the whole rest of if you were invested in tech stocks, and that included 50% SPACs and 50% tech stocks, then like let's say you had $100 million, you put $50 million into SPACs, you're going to earn over a 2-year period probably $7 million on that, something like that. Because you were going to get some appreciation because of the trust was going to grow because of
Yeah, you're going to
the
make
money
money
market. It was
the other
basically
way.
just sitting in a money market
Yeah,
fund, right? And if the whole rest of the tech market is a bloodbath like it was in 2022 and even 2023 to some extent, being in a money market is a hell of a lot better place to be than being in a bloodbath. And so there were a lot of people who looked really smart
it was a good place to
because
put
of
your
that. But
money. I
then
mean,
it ended up being, yeah. I mean, it went from something that was like, oh, you know, this might be a bad deal if we have 50 million tied up here and Coinbase goes up another 100%. We're going to wish our money was in Coinbase instead. But what happened was Coinbase went down 90% or 95%. And so everybody was really glad their money was sitting in a SPAC
yeah.
instead. And so what happened is at the end of that window, though, a lot of people said, "Hey, now I can get my money back out of the SPAC. I don't, necessarily want to put $50 million into whatever company this is. I'd rather take that $50 million and buy Coinbase stock when it's on 95% off sale." And so that's what ended up happening. Is a lot of redemptions started occurring in the SPAC market, and so these things that went from, it's going to be a public entity that's got 100 or 200, $500 million attached to it, went from that to now it's a public entity that really doesn't have anything attached to it, and that's just a lot more challenging situation. So then I think everybody that went through that then had to get creative about where the capital is going to come from and all
Yeah.
that.
So
Another
the
problem.
SPAC you used was, or the business combination was between a company called 7GC,
That's
7GC.
right.
And
Yeah.
is that a United States company or is that a European company?
I think they're like a part like Luxembourg company actually, but the SPAC itself was a NASDAQ SPAC. I mean, U.S.
Yeah,
company.
yeah.
The team is half in the 7GC team. They're basically growth equity investor. They're invested in like Anthropic and a bunch of Hims and Hers, a bunch of really great
Hims and Hers,
successful
that's a
businesses.
billion-dollar company, isn't it? Yeah.
Yeah, absolutely. Yeah, they've done really really well. So 7GC, they got a great team, really sharp guys. They've made some really good investments. They're so we looked at this and we were like, hey, these guys know the tech industry, and that was a big asset for us. Obviously, partnering with them. They had a joint venture partner in their deal. So in their SPAC, it was half the money came from 7GC, half the money came from Hennessy Capital. Hennessy Capital has been a long time SPAC sponsor, going all the way back to
Yeah.
like 2011 or 12. They've done like a dozen of these things. So we looked at it as like, they were doing it before it was cool. So they know how to get these deals done. And that was ultimately really important for us. Because otherwise I don't think the deal would have gotten done if we hadn't had the level of support from those guys.
Experience
But
leadership. Yeah.
exactly.
How do you feel?
But yeah.
Tell me about how you feel about being in a public company now, and also what did that like your equity share look like? Did it just keep diluting down to what does it look like?
I mean, today I think I own maybe like 13, like 11, 12, 13%, something like that.
Yeah.
So, yeah, I've been diluted over time for sure. I think like the biggest challenge with there are a bunch of challenges with taking a company public. After you go public, then you enter like a whole new game. For us, obviously, like our stock traded down a lot from
Yeah,
when we initially
like
went
I was
public.
just looking at it,
It's like
BNZ, BNZI, right?
yeah,
It used to be
yeah. I mean, it's at like
$10 for 2023. Now it's 31 cents in 2024. Like it's a
yeah,
start
yeah.
over.
It's a right. It's a start over. Yeah, it's at a it's at in my opinion, an irrationally low price. We had an analyst initiated a $3 price target a couple of
Yeah,
weeks
if
ago.
all the other companies are in there, that's crazy. Yeah.
So yeah, I mean, it's just something that's kind of been this weird trend in that's happened with SPACs, and there's a whole bunch of hedge funds that have a thesis around just shorting every SPAC. Why not?
Yeah.
So that's been frustrating, but ultimately, it's enabled us to do what we needed to do, which was raise some capital, and hopefully it'll ultimately enable us to get some deals closed. And we're looking at a number of deals now. We're seeing a lot of great deal flow, so
Yeah.
that's been good.
Are you positive cash flow with the current businesses? Or are you still?
No, we're still negative cash
Yeah.
flow. So our hope is that we can put enough businesses together to get to positive cash
Yeah.
flow. So that's what we're focused on right
So
now. Yeah.
what you've got a number of LOIs out?
We do. We have a few LOIs out. There's a couple businesses that we're still working on trying to get to a close with that I think we're making progress on. And so yeah, we're basically just chugging away, and we're seeing more deals come through every day.
Yeah.
So
And where are you getting your
so that
deals?
part
I
is
mean, I
really
know
exciting.
that being in that industry, you could see those deals right around you. How do you find
Yeah.
another, 2 to 5 or $10 million deal? Like,
So the cool thing about this business, this industry, is that there's a lot of fragmentation in the industry. So it's really about finding things that are going to be a good fit for
yeah,
us that maybe aren't fully at scale yet, but where we think we can help them get there. And so we're looking at businesses that are maybe a million, maybe 5 million, maybe up to, I think the biggest we've looked at is maybe 30 million in revenue. And so and there's a lot of those opportunities sitting out there right now. When I started my first company in the big data space, we had a Martech business back in 2010. There were something like 150 Martech companies in the world. Today there's 13,000.
oh my God,
So
yeah,
the space has grown
yeah,
enormously,
yeah,
and it's been cool, but also it creates a problem for marketers, right? Which is just this fragmentation of you got to work with 100 plus different vendors to get their job
yeah.
done. So hopefully we can help solve that problem.
Well, what is it? This journey taught you about yourself, some big lessons. I mean, going from a VC funded thing to thinking, yeah, we'll have an exit strategy. Somebody's going to acquire us. We're going to go public, but to acquiring companies to save, kind of like to save the ship, to
Yeah,
going public with a SPAC. Yeah.
yeah. I mean, it's taught me a lot about resilience. That's probably been the main thing. I think if you're going to do anything, challenging in life, you got to be a resilient person. Because we've had, some things that have, sometimes things go your way, sometimes things don't go your way, as you said, and or as we talked about earlier. And so, yeah, the big opportunity for us, I think, is just trying to stay focused on the things we can control, try not to obsess about the things we can't control, and try to just basically keep working and building a bigger business, building a better business every day.
Well,
Yeah.
well, I wish you the best of success and luck. Joe Davy,
Thank you very much. Yeah, appreciate
thanks
it.
for being on my show.
Yeah,
All
thanks,
right.
John. Great talking with you. Okay.